Hello and welcome to Amagi, hosted by myself, Nima Mahjour of economicsjunkie.com and Dylan Moore of the Volitional Science Network, which you can find on YouTube. We are here to tackle ideas both ancient and modern in an effort to bring you the tools needed to expand the power of your worldview, making you a more potent entity professionally, politically, philosophically, or otherwise. We are graciously being hosted by the Think Liberty Network, which you can find at thinkliberty.com. And this is episode 7, I think? 8? Oops.
We're at
episode
8.
We're going to talk about impending economic doom. Hi, Dylan. What is happening?
Oh, it's the world's just going to crash.
Okay.
I'm going to give it about 30 minutes. It's all going down right now.
Okay, so you got your gold, you got your bitcoins. You're gonna escape to the woods.
And then I think I'm going to melt them down into bullets, because bullets are going to be pretty valuable too. And I figured if I have gold bullets, the value will actually go up exponentially.
Right. And you're going to eat your gold, I presume, because it's really delicious, actually.
Well, if I make it monatomic, I heard there's health benefits to that. So I'll just, get it all in one shot.
Okay.
No, Nima and I, of course, seeing as we've been talking so much about MMT, have come across a lot of people who've been talking about economic doom coming around the corner, particularly now that the Federal Reserve has once again raised their interest rates. You know what that means, Nima?
Yeah, kind of nothing.
Doom. Oh, nothing. Right. Okay. So maybe we should talk about why that's nothing.
Yeah.
And what I wanted to say is that we saw an article a while ago plonking around on Facebook about what a good indicator is of when an economic recession is around the corner. And we thought it'd be a good idea from an MMT standpoint, a modern monetary theory standpoint. What indicators do we look at to see when a recession is around a corner? And the first question I think that we should answer is, what technically is the definition of a recession, and how do we contrast that from a depression?
Right. So it differs from country to country. In the UK, a recession is defined as a negative economic growth for 2 consecutive quarters. And in the US, I was just... Oh, here. Okay. Well, I was just looking it up on Wikipedia. In the US, the NBER defines an economic recession as a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, income, employment, industrial production, and wholesale retail sales. Okay, that's the NBER's definition. And I think generally what they apply is like 3 quarters of economic decline. And then they'll call it a recession. But in the US, it's really kind of, the NBER now declares it's officially a recession, or they don't, and then it's not, I guess. But generally, across the board, we could say if gross domestic product falls consecutively for several quarters, that is a recession. And then what's a depression? Well, there's no official definition of a depression, but a very simple way of looking at it is just a depression is a really bad recession that just keeps on going and going and doesn't end after 3 quarters. It could last several years, and unemployment could remain very high for a long period. I think the Great Recession, as we call it, 2007 through 2008, was like 2 years, which is also longer than most recessions, which is why it's called the Great Recession.
Question.
Yeah.
When we say that we have 3 quarters of consecutive non-growth, is growth defined as the GDP is actually negative, or is simply less than the quarter before?
Yeah, GDP is less than the quarter before. Yeah.
Okay. Can you have negative GDP?
No, I don't think so. I don't see how that can happen, I guess. Well, I guess if you just destroy a bunch of things, and then the depreciation.
Well, isn't that called war?
Right. So maybe it's technically possible. You just have destruction of a bunch of productive factors, and they have to be written off, and they all and all the companies affected incur losses. Maybe then you could, I guess, have negative GDP.
But before we go down that road, or let's hope not to go down that road, so what's up with the federal funds rate? We saw that it just ticked up again, and everybody's... I see two camps' opinions on this. One is it's the acknowledgement that the Federal Reserve acknowledges that the economy is heating up and they're increasing the reserve, or not the reserve rate, the interest rate in order to cool it down. The other side is that the impending doom side is that, oh my God, they're really worried. They're really starting to get worried about paying the interest on previous bonds off, so they're offering more money for people to bring them a reserve so they could pay off more bonds to kick the Ponzi scheme down the road. I think you got a better explanation, Nima.
Technically, really, the Fed funds rate doesn't really do very much. It's, as we've discussed before, when the government, when we start from zero, the government spends money into existence in an economy and then taxes some of it out of existence. Then what we have left is bank reserves. Then banks always want to get rid of reserves because they barely ever need them. So they loan them out at interest, and competing banks will bid down the interest on those reserves to near 0%. So in a free market, in a free interbank lending market, the natural rate would be 0%. Now, what we have in the fiat money economy as we know it today in most countries, we have a Federal Reserve that intervenes and sells risk-free bonds to the banks that pay interest, and whatever interest they pay sort of defines the, or rather what price they sell the bonds into the market at, the treasury bills rather, determines the short-term interest rates. It has now changed a little bit because the Fed has just started outright paying interest on reserves. And so by doing that, the Fed has created a range below and above which the interbank lending rate will never go, because you can always you can always deposit your reserves at the Fed at the bottom rate, and so the rate will never fall below that level. And so what the Fed has done essentially is created a risk-free income for banks and for people who already have bank reserves and money. So when they doctor around with that rate, what they're really doing is they are always pushing it up. The manipulation is always upwards, not like the Austrians say that they're sort of pushing it down, or other libertarians say the Fed manipulates the rates down. That doesn't happen. They always manipulate the rate up. The only logical, or the only proper rate would be 0%, where the Fed doesn't intervene, lets the banks borrow and lend on the interbank lending market. So there's also no real evidence for the claim that raising rates reduces inflation, or that lowering rate causes inflation. In fact, there's evidence for the contrary. As Warren Mosler has explained, when the Federal Reserve raises the interest rate, it leads to a net money injection into the economy. Because when the Federal Reserve raises the interest rate, this means that the banks need to pay more for the cost of funds, and they need to pay more to savers to be competitive, to attract savings deposits. And they will charge more to borrowers. So that's sort of that the two balance each other out. The savers make more, the borrowers make less because they have to pay more interest. However, the money that is injected via treasury bonds is a net injection into the economy. So when the Fed increases interest rates, they always increase the net injection of money into the economy. So rather than reducing inflation, raising rates could actually contribute to more inflation.
But theoretically, not very much.
Right. I guess it depends on the amount of bonds held by the public and what kinds of rates we're talking about here. But yeah, definitely, nothing significant. If it's all within expectations, then definitely nothing significant.
Because when we talk like this, I always find it very amusing, is that when we really downplay the effect of these interest rates and we then turn around and look over how everyone is practically hyperventilating about what the Fed chair is going to announce of what the interest rates are doing, essentially we're saying that the people in this position don't really know what they're doing.
Right. It's kind of like chicken entrails for like past priesthoods, where you probably know better what they did with the chickens than I do. But
why would I know better?
You know all the ancient history stuff. I don't know.
What the hell?
Didn't they like cut the chickens?
I don't know where that came from.
Didn't they cut the chicken's head off and then let the chicken run, and then based on the trail, the blood trail?
I think you've been watching too much South Park, man.
Well, I thought South Park. I did.
Did you see that episode?
Yeah. Anyway, we'll talk about chicken entrails in the next episode. But
okay, I will answer that. Here's my limited knowledge of that sort of thing. Is like any other divination. Is you had something that you did something where the outcome was essentially random. Like, I don't know if you cut the chicken's head off and let it run around and see what it did, or you cut it open and threw them in the air and see where they landed, or you throw some stones in the air, you roll some dice or whatever. It essentially is random as far as the person watching is able to tell. Therefore, whatever occurs, you could say is an act of some sort of divinity, and that's the message that you're getting. And of course, you need some sort of divine person to interpret it, which is why it's all nonsense, because even if it was divine, the person who's interpreting it could make up whatever they wanted anyway. So just to emphasize what Nima's getting at is they're completely making shit up.
The Fed just looks at, what's the price level now and how's it developing, and oh my god, the prices are now rising at 2.2% versus 1.7%. We have to raise the interest rate, as if the two had any correlation, but they don't really. And what we've also, like, people say in the end of the 70s, 1980s, Paul Volcker, the Fed chairman, then he really cracked down on inflation, right? Except he didn't. Inflation didn't go down. The rates kept on going up, and inflation just kept on going up and up until the price of natural gas was deregulated. Because the reason for the inflation at the time was that a monopoly price setter, aka OPEC, was raising oil prices to never before seen levels, I believe. And so that just, oil is a commodity used in production everywhere, so that led to price increases everywhere, and very high prices at the pump, long lines at gas stations, etc. And that pretty much ended when the price of natural gas was deregulated, not because the Federal Reserve raised interest rates. Actually, they raised interest rates to such a level that it was actually causing some trouble for the banks, because there was savings and loans banks who were rolling over short-term deposits and had made long-term mortgage loans like they were supposed to, like banks always do. But suddenly they couldn't finance their funds anymore, because the Fed funds rate was so ridiculously high, just so arbitrarily high. So a lot of these banks went out of business. It's known as the savings and loan crisis or debacle or whatever. And
Is that because the potential borrower simply couldn't afford the loan because the interest was so high?
No, it was because loans at the bank that the banks had already made. Let's say you made loans at 5% for 30 years, and now you have to finance those loans with either you borrow
with 18% money.
Yeah, either you borrow from the Fed or you borrow from savers, and usually you try to attract savers so you can get a slightly lower rate than you get from the Fed, and then that's your cost. So your revenue is interest income, and your cost of funds is the interest you pay on the deposits or on the funds that you raise from the Fed. But if the rate is so high, like you just said, 18%, then that's a net loss. So a lot of banks had to go bankrupt for that reason.
It never occurred to me that raising rates so high, so fast like that could create an issue for the bank, where if they have to compare to, what the loans that they made before, and they say, okay, we made it at an interest rate which was a fraction of what the rates are now, we can't continue to finance the loans that we made in the past because the money today is simply too expensive.
Exactly. That's what happened.
Interesting. So, Nima, if the federal funds rate isn't our indicator of a recession, what is?
Well, so let's just say one way in which the federal funds rate could be a recession indicator is if you look at the yield curve and you start noticing that the short-term rates are rising above long-term rates, then that's an indicator that people on the bond market are betting that rates are going to come down shortly. And then by extension, why would they come down? Well, because of a recession, because the Fed reacts to recessions and to depressions, and they will cut rates when that happens.
Now, can you go through that again really slowly?
Yeah.
For people like me and people who may get it even less than me, who aren't so familiar with these, I don't know, financial trading operations.
So the government sells bonds of different maturities. It goes from 3 months to 1 year to 30 years ultimately. So all the short-term bonds, they are basically just trailing the Fed funds rate. They're basically around the level of the federal funds rate. They are essentially kind of like betting on, or just they let you receive that income that the Fed pays out through the federal funds rate. If you buy like a 1-year treasury, that rate is always sort of around the current Fed funds rate and or expectations for the coming months, but only up to a year. Or you can.
When I buy that treasury, am I buying that directly from the government, or is there like a dealer in the middle or a market?
It's usually a dealer in the middle, but you can also buy it from the government if you want to. You can buy it at treasurydirect.gov, which is I think it's a treasury website, but usually you would buy it through some dealer, like Fidelity or whatever.
So when you say that the price that you're going to pay for it isn't maybe a little bit different from what the actual bond is, that's because you're not necessarily getting it directly from the government. You're getting it on this market where there's some market forces in play for the value. Do I have that right?
Pretty much, you're probably going to pay about the same price either way. It's the market just adjusts. The market determines what the rate is, because if the price goes down for a bond, then the rate goes up, because let's say you have a bond that's $100 and it pays out $5 every year. So that's a 5% bond then, right? Now, if that bond falls to $50 value, it'll still be paying out $5. So then now it will be 10% that you would be receiving.
Okay, and the value of that bond is whatever you and I agree it is.
It is,
right? If I paid $100 for it yesterday and I want to get rid of it, and you're the only person who's willing to pay for it, and you're only willing to pay $50, now it's only worth $50, right?
Yeah, in a very simplistic market like that. In general, it's
It is an extreme
In general,
example.
the rates for these bonds, on the very short end, they're basically just trailing the federal funds rate. So the value of these bonds is determined by a Federal Reserve policy on the very short-term level, or the interest that they pay. On the long-term level, these bonds are essentially just bets that, whatever the short-term rates in the meantime I can get are going to be lower than this long-term rate. So, for example, 30-year Treasury right now pays 3.4%, and the 1-year Treasury pays 2.6%. So the reason why I buy a 30-year Treasury at 3.4% today is because I think that for the next 30 years, the average, if I roll over all my 1-year bonds in the meantime, the average interest that I'm going to be receiving on those will be lower than 3.4%.
Vocabulary. When you say roll over, you mean when your short-term bond matures, you immediately buy another one.
I buy another 1-year bond, wait another year, sell, buy, and then I do that for 30 years. And then my speculation is that if I buy a 30-year bond today at 3.4%, my bet is that all the individual short-term bonds in the meantime are going to be, on average, below 3.4%. It could be 2.6 this year, could be 2.8 next year, could be 3.5 the year after, and then it could crash down to 2.5 the year after, or whatever. It's very difficult to predict these things. So that's why these are probably, to an extent, more emotional decisions. The longer you go on the curve, the more it's a speculative investment. And the harder it is to predict, and also the more volatile the bond is, which is why in the permanent portfolio that we discussed a couple of shows ago, you want to buy the longest term bond because you want to have the highest volatility at the moment when long-term bonds rally, because then you'll get the biggest bang for your buck. But so these are just the dynamics between long-term and short-term bonds. So I'm saying look out for inversions of the yield curve, which means, for example, right now, let's say a 1-year Treasury bill, let's say it goes up to pay and pays you 4%, and the 30-year bond still only pays 3.4%. Okay, so why would you buy a 30-year bond at 3.4% if you can get a 1-year bond at 4% today? Well, the answer is because you think that the average over the next 30 years will be lower. And how is that going to happen? Well, because maybe I think a recession is impending, or a recession is coming up in the next few years, and the Fed will start cutting its rates heavily. So when I roll over, then the next available bond will be at a lower rate again. And so when the yield curve inverses, that tells you that bond investors don't think that rates will keep going up much longer, and they rather expect that rates are going to be coming down. But the reason why rates come down is usually a recession or depression or some event like that.
Okay, now this feels like chicken entrails to me. So there's this relationship between the bond investors and their expectation of the announcement of the Federal Reserve, right? Because, and the Federal Reserve's interpretation of what needs to be done under certain economic conditions, which in themselves are based off of chicken entrails.
Well, the Federal Reserve's decision is based off chicken entrails, but the people who are buying and selling these bonds, they just want to make money. So they know that the Fed is going to act in this or that manner, and so they adjust accordingly.
Based on the way they've acted in the past.
Yes, exactly. This would all change if the Fed declared tomorrow that they're going to be dropping the rate to 0.25% and they're going to leave it there for eternity. Something they could totally do. Something that would return immense, something that would bring immense calm to the markets, and eliminate an entire area of speculation that's pointless.
And that's why I called the whole thing chicken entrails, because it's not like there's real economic forces, like what we're going to be talking about in a minute. It's not like there's real economic forces crashing and burning that's causing that would cause a recession or cause a depression. It's just kind of this expectation dynamic between the Federal Reserve and these investors.
Well, it just shows you,
and speculators.
It shows you these investors, these speculators, they may know something that you don't know. That's all.
Got it.
And okay, let's leave it at that with the inverse yield curve. Another thing to look at, obviously, private sector net savings. If that goes down, then that generally means the private sector has less or fewer safe assets at its disposal compared to the income that it's earning, which generally...
And what is private sector net savings again?
Private sector net savings is the government's budget deficit plus the current account surplus. In other words, any money that's been spent into the economy that is not owed back. Because all other money, the majority of all money, is created by private banks and created by bank loans. When the bank makes a loan, it marks up a deposit, and that increases the money supply in the private sector. But at the same time, the borrower owes that money back. So the bank books a loan on its books owed by the borrower. And so it doesn't change the private sector's net position. It's basically a wash. It's zero. But if the government deficit spends money into the economy, then the assets that it spends into existence are essentially bank reserves, and those can also be exchanged for treasury bonds or treasury bills, much like we just discussed. But these are all assets that the private sector holds, and that the private sector, in aggregate, holds and doesn't owe back. These are assets that are there to be safe haven assets and to keep us liquid.
And that's why we call it net savings.
Exactly.
Right.
It's
because once we balance out the liabilities with the assets, the net savings is what's left over.
Exactly.
And then you also mentioned current account surplus.
Yes, current account surplus. If we sell more to people in other currency countries, then they buy from us, then they need to obtain dollars from our bank, from the Federal Reserve Bank, essentially in the end. And the Federal Reserve Bank accumulates foreign currency reserves, and we accumulate dollars that are not loaned out, they're not owed back, essentially. So that's another method of obtaining net private savings for the private sector.
Got it. And then I interrupted you when you were about to explain why the private sector net savings is important for looking out for recessions.
Right, because every time, if we look at, for example, in the US, since 1776, we have seen that every time private sector net savings went negative, we entered a depression, actually. So it's a very strong indicator. It's not just a recession, but a depression. You can have recessions without this happening, but if private sector net savings goes negative, it's really an indication that we're in dangerous economic territory.
It's the big one.
That's the big one to look out for, yeah. For example, we saw this towards the end of the 1990s. The Clinton year surplus, etc., led to private sector net saving going negative. And then in 2001, we had a recession. And then from 2001 through 2007, the U.S. current account deficit grew big time and grew very large, and which once again
meaning we were importing a lot of stuff. So goods were coming in and money was going out. So money was leaving to the foreign sector while simultaneously the government was taxing more than it was spending, pulling money out of the private sector.
Yeah, they didn't actually do that, but the current account deficit was so large that it didn't matter. Once again, it drained the private sector of net savings, and those went negative. And then 2007 2008 we had the Great Recession, which is basically was the consequence of that, and that's when the private sector retrenched and savings went up, and we had a big recession, and then the rest is history, as they say, I guess. And that is private sector net savings. Any more that we need to?
Yeah. So can we look at why that might be the case? Because I find the explanation to be fascinating. Because we've talked about this before, that so as we just described, when the private sector net savings dips, at least in United States history, there's a 1-to-1 correlation. Every time that dips, bam, we have a depression or a recession.
When it goes negative, to be precise, yeah.
Thank you. When it goes negative, when it dips under the zero, and what's interesting to me is because this government deficit, the amount of money in the economy generated from or created by the government deficit, is actually a very small amount in the total aggregate money. Most of the money, as we said, is bank loans.
Yeah. Why is the private sector's net savings important, or why is it a helpful figure to look at? Well, the private sector in any economy always wants to net save. That means accumulate safe assets being bank reserves and government bonds primarily. And why does the private sector want to do that? Because the private sector wants to save for retirement, and the private sector is not an issuer of money, so they can run out of money, and for those reasons they want to have savings to feel safe and secure in the economy, in the monetary economy that they operate in, and so that they can pay future taxes and future bills, etc., etc. So the private sector wants to net save to a certain extent. Now, when private sector's net savings goes down, that means the government overtaxes the private sector. What happens is that the private sector will start relying on banks more and more, to the point where it gets excessive, and to the point where, due to overconfidence, etc., the private sector borrows too much money from the banks to where at one point it can't repay those loans anymore. And when it can't repay those loans anymore, then the banks stop lending out, and then we have a sort of deflationary cycle or deflationary spiral, wherein the private sector begins panicking and starts spending less, and that means that aggregate demand falls, and when aggregate demand falls, then businesses make less money, and then businesses lay people off, who then have less money, who then can spend less money, and so on and so forth.
And banks freak out too. I mean, at least they did in our last recession. Is they stop lending money to people. They call loans due. They call lines of credit due. They call credit cards due, and it's just like they turn their money spigot off.
Yeah, because the private sector has overextended itself, has borrowed too much, borrowed beyond its means, and now can't repay, now doesn't want to borrow anymore because they don't want to be in debt anymore, so they won't consume anymore, which means that businesses are not going to make money anymore. And so, this sets off...
The businesses go out of business, and then everybody gets laid off, and then downward spiral.
Right. And so what happened in the case of the US this time in 2008 was that then just the government deficit grew very large, which once again, because that's just what happens when you have a recession, you start having less tax income, and you may have a little more expenses on welfare and or unemployment, etc. However, the large majority of the deficits that were generated after the Great Recession weren't really from government spending programs. There was some a program enacted under Obama called the
TARP.
Well, TARP was just a bailout, but I thought there was some program to do public spending projects, and it was really more like public-private spending, but it wasn't really the reason for the deficit. The reason for the deficit was tax receipts collapsed, and thus the deficit grew, and over time the private sector retrenched and came back, as we can kind of see now. And so the best would be if there was always a certain level of private sector net saving, so that the private sector doesn't even need to panic to begin with. But the problem is with progressive taxation systems is that taxes tend to go up and up the more economic activity increases. And then, that's something to be tackled, I think, at one point, where if we want to have sustained economic growth, or maybe we are tackling it right now under Trump, I don't know, but if we want to have sustained economic growth and minimum recessions, depression, shocks, then we should always make sure that we have a certain level of private sector net savings, which in turn means that there should be a certain level of government deficit, so that there are safe assets in the economy, so the private sector doesn't freak out, doesn't overborrow, by the way. If you have large government deficits, then the private sector will borrow less, will go less into shaky debt positions.
Well, and then also one thing, we've mentioned this before, is underwriting standards. Because I think one of the things when the private sector gets super confident is the banking sector also gets super confident, and they just start going, hey, everybody can have a loan. Yeah, we're not going to check your income. Yeah, who cares? Just take it.
Yes.
And of course they get overextended if that's the way the money is getting printed.
Yes, and this is something we're going to talk about in one of our next calls. Hyman Minsky talked about this extensively, and he basically developed a theory, and the short version of it is that stability is destabilizing. The more confident economic actors become, the more reckless they become. And the more reckless they become, the shakier the private sector's position becomes. And so on and so forth. Which is why he precisely devised methods of allowing for private sector net savings to accumulate in each cycle or in each phase of this type of economic cycle, with deficits maintaining a certain level and ensuring that the private sector doesn't borrow excessively, as they did in the Clinton years, for example, and also as they did in the lead up to 2007, 2008. So you're right. The private sector, the more confident the private sector gets. By the way, I just want to throw that in as another indicator. When the private sector gets very confident that things are just going to get better and better, that's oftentimes a very good sign that there's something's up, bad recession around the corner. That the recession is not around the corner, in my opinion, when everyone is worried that there's a recession around the corner. That is actually a great time for sustainable economic growth, is when the majority of people are just constantly worried about some crash coming around the corner, if that makes sense.
Absolutely, because they're being fiscally conservative, if that's the case.
Right. So,
well, I mean,
that's why whenever I read,
hedging their bets a little bit better as opposed to the cocaine fueled style private sector borrowing that went on leading up to 2008.
Yeah, no doubt. That's why whenever I see like a lot of articles suggesting you may want to be careful with your stocks, the crash is around the corner, which I still see those off and on. I've seen those many times over the years, and it's just great because that is a bullish indicator. If you read a headline like that on the idiot mainstream media, that is a great indicator that there's actually no recession around the corner. Because the recession is around the corner when the idiot media proclaims that recessions are a thing of the past. We've reached a permanently high plateau. Everything's great. Blah, blah, blah. The case for Dow 50,000 or whatever. When you read that kind of stuff, that's when you want to get worried. And it's difficult because at that time everyone is euphoric, and you yourself are probably in some state of euphoria. But that's the time when you want to watch out, when everyone unanimously agrees that times are great and will never end.
So we've done inverse yield curves. Now, we just went over private sector net savings, and the thing to look out for is the dip. The dip in the private sector net savings, which could occur one of two ways, or a combination of the two ways, which is government spending, or more specifically, the government deficit, how much money is left over in the private sector after the spending and taxing has occurred. And the second one being the current account surplus, which is how much money has entered the country via exports, or I guess you could also say the other way around. How much money has... wait, I said entered, didn't I? I meant to say exited
in
earlier.
the case of a surplus, the money enters the country. In the case of
money enters the country, stuff leaves it. As opposed to right now, we're bringing stuff in and money is going out.
Yes.
So in that case, in order to make up for the fact that I think hemorrhage isn't really the right word, but I'm going to use it anyway. We're hemorrhaging money to the foreign sector. The government is going to have to pick up the pace in order to make up for that.
Exactly. And that's why Greece, for example, had such a terrible depression, because they were told to run a balanced budget while still running a current account deficit, a chronic current account deficit. And that applies to all the other troubled countries in the Eurozone. All these countries, problems could be saved if they listen to this theory that we're talking about here, basically.
Yeah. And that's why Germany can be all stuck up and say, well, we can balance our budgets. Look at us. Yeah, exactly. Well, they're exporting all their stuff and essentially cannibalizing the private sector net savings from the other Eurozone countries.
Yes. Germany is having the other Euro countries save for them, and the other governments deficit spend for them. So they can talk a big game about, we can balance our budgets. Look at us. Well, what's wrong with you people? But, it takes two to tango, or, in the case of Euro, it takes many to tango. Germany is living on the backs of the countries that are suffering the most in the Eurozone crisis. Greece, Spain, which right now, they're apparently doing better, but we'll see where it all ends. But if they keep their requirements of having a 3% budget deficit and no more, and stuff like that, then they will run into the same problems again. And maybe it's by design. Maybe they just want to cripple these economies for whatever reason.
So when we have a private sector net savings dip, at least historically speaking, that means a recession is coming. Now, however, just because a recession came doesn't mean that there was a private sector savings dip. So what's one more way, or one more thing that we can look out for to know that a recession might be coming?
So there is an equation for aggregate corporate profits called the Kalecki equation. Kalecki was a friend of Minsky's, I believe. And Kalecki...
Can you spell that?
Yeah, it's
so someone can look it up.
Kalecki. Kalecki equation. It's a very fundamental, important equation to understand, I think, if you want to understand stock markets in particular. Because the Kalecki equation... The Kalecki equation explains the sources of corporate profits and of aggregate corporate profits. So if you look at the entire U.S. economy, you add up all the profits and all the losses, etc. You add it all up, you get the Kalecki equation, which is corporate profits equal investment spending plus government deficit spending plus the current account surplus, plus capitalist consumption, minus household saving. So if any of these numbers moves in a direction where corporate profits in aggregate look like they are falling, that gives you an indication that the stock market in aggregate is going to drop. And by aggregate, I mean, if you look at some of these index funds that we talked about last in our show about the permanent portfolio. If you look at some of these large aggregate index funds, they basically react to aggregate corporate profits. But then in turn, most other companies that are in these indexes, etc., unless they have some business-specific successes or whatever, they're also going to suffer to an extent. So yeah, corporate profits is definitely a helpful indicator to look out for. And corporate profits together with the risk-free rate gives you a sense of where stocks are going, big picture. The corporate profits could remain unchanged, but if the risk-free rate, which is, as we just discussed, the rate that the Fed pays out, goes down significantly unexpectedly, I don't know why that would happen, but maybe some Fed chairman who understands economics is appointed one day and declares a low rate of quarter point for eternity, that would certainly be a big boost for stocks, because stock valuation always depends on what's the interest or what's the return on the risk-free alternative. If the risk-free alternative return is very high, then stocks are valued less in comparison. So yeah, Kalecki equation and its individual components. Investment spending is a huge one.
Components, because we went over heavily government deficit and current account surplus, which I think is easy to understand, also in this corporate profit sense, because it's more money for the corporations, right? And so investment spending.
Yeah,
tell us exactly what that means.
Investment spending is purchases of capital goods, such as factories and capital equipment. So in other words, goods that are not used by consumers, but goods that are used by businesses to aid in the production process. And investment spending in particular leads to spending or generates incomes for the people in the investment sector, who then buy products from the consumer sector, while they themselves don't produce any consumer goods. So in the most simple framework, let's say there's no government, no foreign sector, and no savings, then the only source of aggregate corporate profits would be investment spending. Because otherwise, if there was no investment spending, only consumer spending, then anyone's gain would be someone else's loss. But if there's investment spending in the economy, then the corporate sector can actually accumulate a surplus, because the people in the investment who are working in the investment sector are not churning out consumer products, yet they purchase consumer products from the consumer goods sector. And so the people in the working in the consumer goods sector can't afford those products because they're priced such that people in the investment sector can buy it, and that then generates a surplus for corporations, an aggregate surplus, not just a surplus for one corporation or another. And we can extend this model from investment spending to then we have government spending. The government injects more money than it taxes out of the economy, and that money also ends up with corporations because the government buys stuff from corporations. Except if the household savings goes up, which is why we introduce household savings, that is a negative on all of this, of course.
Right, because I'm keeping it in my piggy bank instead of spending it.
Yes, and the same same goes for export surplus. We have an export surplus, means we're selling more to abroad than we're buying from abroad, and that money ends up, ultimately in the form of corporate profits, aggregate corporate profits.
And so, when aggregate corporate profits dip, why does this cause a recession?
Well, I mean,
why could it cause a recession?
Well, because that means corporations are less likely to be optimistic, so then they might lay off people so that they can retrench. And when they lay off people, then those people have less money, and then they spend less. Then everyone just panics, and
Then there's less corporate profits, and then there's
Yes, it's a
less
spiral.
capital consumption, and
Exactly.
so what are the current corporate profit outlook?
Well,
What-
currently it's on all fronts. It's very good. Investment spending I think it's just reached record levels under Trump. I mean, especially because Trump is getting rid of a bunch of totally stupid environmental regulations that are nothing but neoliberal austerity.
Agenda 21.
Yeah. I mean, just
Garbage.
You can't breathe anymore. You can't have cows anymore. I mean, it's just absolutely ridiculous activist, unscientific activist nonsense that has been enacted over the past decades or so that is currently being nixed. I mean, at least I hope, I hope it continues.
At least at the federal level.
So that's
Still pretty rough at the county level.
Yes.
At least where I'm at.
And that's the thing. But definitely.
We
So
could do
that's
another
one.
podcast
That's
about that.
That may be one reason why investment spending is soaring so much. And then also, of course, we have a large government deficit. So that's the next number. Government deficits are now back to I think about 1 trillion or more, and there doesn't seem to be much concern about it, which is a good thing because we do want a big government deficit, especially in an economy like the US that is still underutilized. Only 70% industry utilization, so we still have a way to go there. And so deficits are also currently a positive factor. Okay, then we have current account is sort of is a wild card. We don't know where it's going. It's been slightly going up in terms of the
You mean less negative?
Yeah, less negative. The current account deficit has been falling a little bit, but not much. So I don't necessarily think. I think Trump wants to make it into a surplus. I don't know if he can or if it's even a possibility, but we'll see where that goes. But if that is,
He's at least pushing it upwards.
Yeah, if he can, then
And he's talking about pushing it further upwards.
yeah. So we'll see where that goes, but there's no clear indication one way or the other. But if it goes up, then once again, that's a positive thing for corporate profits. And household savings.
Capitalist consumption.
Oh, capitalist consumption is kind of, I think it's a small item. But it's kind of hard to determine. I think the way some blogs have seen determined is just dividends. It's just, I guess you could say dividends. Yeah, I guess that makes sense. Dividends. And those, I don't know. I mean, it's not a very significant component of all of this when compared against the other big figures. But I don't.
Got it.
I mean, they're certainly not going down. Dividend payments, etc. If anything, they're just going up. And stocks are doing well for that reason in part. Or rather, stocks are doing well because corporate profits are doing well, and because corporate profits are doing well, dividends payouts are good. And then also, we have household savings, which I don't think has. It's definitely not gone down. Consumer confidence is. Household savings is definitely not gone up much, and it's different from net private savings. By the way, it's a little different, but
yeah, it's kind of because the household savings includes the private money that's generated by banks, right?
Yes, but household savings
It's not net. It's not looking at everything altogether. It's just looking at what the positive assets are.
And also, it's not corporate savings, right? So corporate savings are also part of net private. Net private savings is the entire private sector. Household savings is only workers, not corporations. So household savings, I haven't looked at recently, but as far as I know, it's not really strong one way or the other. So there's definitely consumers' confidence is up. So these kinds of leading indicators give us a sense that household savings, private sector is not looking like it's about to freak out. And
so here's a question for you.
Mm-hmm.
the way this is sounding like is that the household savings and that the corporate profits are fundamentally at odds with each other.
Definitely.
So
Yeah.
is this going back to the fact that we can't have a healthy business if people aren't spending beyond their means?
Well, doesn't have to be beyond their means. You can definitely have a healthy business without people spending beyond their means. It's just saying that
you have to have enough money in the system. I was playing devil's advocate when I asked that question.
Yeah, I mean, it's just that when the household sector reduces, or when the household sector saves more of the money that it's earned, then that money doesn't go to corporations, and so that's then reduces the corporation's profits.
You know what's an interesting point? I've heard Warren Mosler bring this up as well, is the retirement accounts in this country. That there's something like, let's see if I remember this number correctly, $26 trillion sitting in retirement accounts in the country.
Mm-hmm.
And that's essentially money that's been frozen that you're supposed to be able to access it when you turn 65 and a half or whatever. But for the most part, and there are ways to access it, but most people don't know it, and they're a little bit tricky. It might be worth making a episode just on that. But for the most part, these assets are frozen. So that's $26 trillion that, if the rules got lightened a little bit, could be sent back to reinvigorate the economy.
Yeah.
And participate in these corporate profits, but instead they just rot away in these retirement accounts, collecting 2% or whatever the hell they're getting.
It's possible, yeah. I mean, people can take them out, but they incur penalty currently, so yeah.
Right, and they don't, and they don't to the tune of 26 trillion.
Right. So. Or it could also just very well be that they want to have that money in there.
Well, in my anecdotal experience, because one of the things that we've learned to do, or one of the things the real estate investing world figured out how to do after the 2008 crash, when all the money was turned off, is they really started digging into the rules regarding retirement accounts, and they found out that, as I just mentioned, your retirement account can pretty much invest in anything. There's three things that a retirement account can't invest in, and that's life insurance, collectibles, and the shares of an S corporation. And what the rules regarding retirement accounts are less about what you can invest in versus who you can invest with. And I won't even pretend to get into the wacky rules about who you're not allowed to invest with. But the point is that you could invest in real estate, you could invest in a business, you could invest in Bitcoin. You could throw that thing at anything you want as long as it's self-directed. Because legally speaking, only those three things that I mentioned are the things that you can't invest them in. And when at least in this real estate group that I'm in, it's a common occurrence that people run into where they're sitting on all this retirement account money and they're like, it's there, I want to do something with it, but I don't know how to touch it without incurring all these penalties. So it's just sitting there.
Yeah, no, definitely. I mean, there could be another way to boost aggregate demand then, if that is the case.
Yeah. But sorry, we got sidetracked there. To close out of corporate profits here. So again, zooming out and looking at it as an indicator of a recession, particularly when we look at these individual components, the investment spending, the government deficit, the current account surplus, the capitalist consumption, and the household savings. Again, the two big ones that jump out of there are government deficit and current account surplus. That if these things start to dip, it's going to spiral out. It can spiral out of control, where people get laid off and they stop consuming so much, and so the corporations get less profits, so they lay more people off, and then you got a problem where you need something like more government deficit or a better current account surplus to kick things back into order.
Yeah, no doubt. No doubt.
One last point I wanted to bring up, and I want to preface this by saying I have no fear whatsoever that this is going to occur in any modern first world nation, including the United States or anywhere in Europe. But that's hyperinflation.
Yeah.
And one of the things that to look out for this form of recession, and recession is kind of a weak word when you're talking about hyperinflation, which is the collapse of productive capacity.
Yeah.
Or the collapse of production. And we've talked about Zimbabwe, we've talked about Weimar, we've talked about Venezuela in previous episodes, but essentially, MMT points out that hyperinflation isn't caused by the creation of too much money. Hyperinflation is caused by the destruction of goods and services.
Yeah, the destruction of factors of production, mostly.
And in Zimbabwe, I wanted to talk about that one because it's going to correlate to what I wanted to say after this. Zimbabwe went through their land reform where, as far as I understood it, they essentially kicked out all the white productive farmers and looted and pillaged the farms where, you know, they just ate what was there and then didn't grow anything else. And now all of a sudden, oh, hey, we don't have nobody's making anything anymore. Therefore, there's nothing to buy.
Or they took metal parts or whatever they could get from the farms.
Yeah, just scrap it.
Yeah.
The one place that I would look for hyperinflation coming around the corner, I mean, Venezuela's already hit it, so not there, is South Africa.
Well, yeah, it depends on how much they go through with a comparable program.
But these are the indicators.
Yes.
Right? If they start pursuing a very similar land reform as Zimbabwe did, I mean, connect one thing to another. In my real estate group, one of our group members is a refugee from South Africa, which we might even want to have him on at some point just to talk about what's going on there. He essentially said that he got tired of getting shot at.
Yeah.
Which is why he came here. And actually, I want to say this part. He told me that the straw that broke the camel's back for him, because he's a business guy. He was a real estate investor doing projects down in South Africa before he even came here. And so he was doing some business where he was being pretty successful. And then a government official came to him and said, you need to give 40% of your business to a black person because they had some sort of economic buddy system. Test.
Okay,
you
back.
What's the last thing you heard from me? I think I could pick this one up.
You're a friend from South Africa. You were just starting about him. He was tired of being shot at.
Okay, I'll just start it over. Yeah. I'll pause and get into it. So he told me that the straw that broke the camel's back was... He was a businessman and he was doing real estate investing and stuff in South Africa before he ever came here. And he had some successful business venture that was going on. And at some point, some official from the government came to him and said, you need to give 40% of your business to a black person because we have some sort of like buddy system. There was some stupid fucking phrase that they had for it that he told me that I can't remember. But the pillaging was very direct and legalistic, where they literally came to him and said, you must give 40% of your business to a black person. And that was when he said, I'm out, I'm done. I can't handle this anymore. And since then, he's been trying to get into the United States.
Yeah.
And so that's whatever productive capacity he brought to the table is no longer in South Africa.
There you go. Leaving the country. Yeah?
There you go. Okay, Nima.
Well, maybe one more interesting
conclusion
thing to mention is, also people talk about currency crises sometimes, and what causes currency crises? Well, currency crises are usually caused by excessive private sector foreign debt. So if your private sector has borrowed a lot from abroad, or if any country's private sector has borrowed a lot from abroad, that's not good, and that can lead to currency crises inside the country. And some of the country,
because the country owes a foreign debt in a money that they can't create. For example,
Hungary is on top of the list of countries with private sector external debt, with over 50% of GDP in Hungary, about 40% in Turkey, about 37% in Greece, just about 30% in Russia, and a little bit, 28% in South Africa. Those are sort of the top 5 foreign, or the top 5 currency crisis candidates on my watch list.
Wait, who is number 1 again?
Over 50%.
50%. My oh my.
Yeah.
Because that goes back to what we always talk about at MMT. It's a big deal if a country is able to create its own money, and if it owes a debt in money that it can create versus owing a debt in money that it can't create. And if your private sector racks up all this debt in money that its government can't create,
doubly bad.
Well, it can't deficit spend itself out of it.
Yeah, even China has like 15% private sector foreign debt. The US is nowhere on this list. I mean, people always talk about, oh my God, we owe money to China. No, we don't. We've spent dollars into existence, and we are offering bonds that pay in money that our government can generate. Completely different. Not doesn't compare at all. But yeah, these are countries that are actually owe foreign money, so that's not good. And we can share the chart in the footnotes. Yeah. Excellent.
All right, Nima. I think we're getting to the end here. What moral can we draw from this story? What's
Well, I think
what's to worry about?
Depending on where you're at, if we're in the US, don't panic. Things are looking pretty good right now, and look out for the indicators as we've described. And
none of these indicators are going off.
Apparently not. Exactly. And always be wary of doom and gloom porn, because it's oftentimes very compelling, but usually not very factual or empirical.
Right, and then particularly if you see doom and gloom porn based off of the federal funds rate, you could just put that one aside.
Exactly. And with that, I think we covered it all pretty good here. This has been Amagi, hosted by myself, Nima Mahjour of economicsjunkie.com, and Dylan Moore of the Volitional Science Network, which you can find on YouTube. And we are being hosted by the Think Liberty Network, which you can find at think-liberty.com. We look forward to your comments and your questions and your rants and hatred or whatever you want to send our way. And we will see you next time.